After a week full of bold promises of reforms for China's future, today we see how the world's #2 economy is actually doing right now. A key preliminary measure of its manufacturing sector health, the HSBC Market Flash PMI, coming in at a tentative 50.4, a moderation from last month's final print of 50.9. That's on a slower pace of restocking and a negative dip for the new export order sub-index, suggesting trading partners abroad are not snapping up as many made-in-China goods as some may hope. Mark Conan, CEO of asset manager Cathay Koning.
Certainly headwinds in terms of exports. Most of the recovery that we've seen portrayed in the developed world has come through the service sector. So that big push through of export growth is really not materializing for China. So that's making life a little bit more difficult as China shifts gears and tries to focus more on internal factors.
Weaker exports may explain why, after letting the RMB strengthen tantalizingly close to 6 to the dollar, the PBOC has been fixing the yuan weaker. That may catch offshore RMB traders off guard. They've been pushing the Chinese currency higher against the dollar in Hong Kong trade, with the spread you can see on the bottom there between the fix and the offshore now at its widest since January 2013. In the long run, the offshore bet is likely to prove right. As part of the reform blueprint, Central Bank Chief Zhou has said the PBOC plans to wind down regular intervention in the foreign exchange market. Old habits, though, do die hard, with China's economy likely to soften in the fourth quarter. In the near term, at least, reform may not be a smooth ride.